Hey folks, I'm Will Bridges from your team here at 123 Trade. In this video, we're going to be discussing inflation in the US, interest rates, a potential interest rate hike, what an interest rate hike might do to your investments. All of those things are going to be very important. There's been a lot of news to get released here recently. We're going to be talking about this in our session on Friday. If you want to see more videos like this, by the way, like, subscribe, ring the bell. We're going to be coming out with lots of time-sensitive information data like I'm about to give you here. And I am going to show you a little bit of a forecast for what I think may happen to the dollar after what Janet Yellen has just come out and said and what Jerome Powell has been singing for months. First things first, let's go ahead and get our risk disclaimer out of the way. What this says, everything in this video is going to be for educational purpose only. If you put your money in the Forex, your capital is at risk. You do have to risk it to get the biscuit, folks. There's no such thing as a guaranteed trade or investment. The only thing you can control is your risk. But let's get over to the news. I want to show you guys a couple of things here. And first things first, I just wanted to do a real obvious U.S. interest rate search. This is what happened. So you end up looking at news about Yellen says higher interest rates would be a plus for the U.S., Fed. I'm not surprised that she thinks they would be positive for the Fed, because what that really means is that the Fed would be charging more money for the money that they lend to the U.S. government. Because I don't know if anybody realizes the Federal Reserve is neither federal nor a reserve. Discuss. It's not really either of those things. Okay, so they're not federal, they are a privately owned entity, and if they increase the cost of their product, yes, that would be good for the Fed. As far as the U.S. goes, what Yellen is saying is that, if they did something like that and they raised interest rates, that might curb inflation, and she thinks that that would be good for society as a whole, and maybe that's true. They're also talking about a massive $4 trillion infrastructure plan from Joe Biden. And yes, that would likely be good for society to have this infrastructure. Kind of depends on if you're okay with paying the taxes for it. Because right now, if we wanted to pay off the U.S. total debt, we would have to take every person alive on the earth, globally, and have them pay $3,500 today. That's what it would take to pay off the U.S. government debt. So yes, it would be great for society in the U.S. here if we built a bunch of stuff and we had nicer roads and bridges and, high-speed trains and all this other stuff. But the truth of the matter is we don't have the money. So we're also going to increase the cost of this money should we decide to do that, according to Janet Yellen, and that's what she thinks is really the best way to go about it. We're getting a little bit of a different tune from Jerome Powell. Jerome Powell is talking about, asset purchasing has to slow down or taper off before we were to decide, something like raising interest rates. I don't know if you guys can read this here. Currently, the Fed is buying at least 120 billion of government-backed securities per month. What that means is that they are buying their own securities. It's the equivalent of a company like Apple, for example, buying their own stock, or American Airlines buying their own stock so that they can pump up the price. They are buying their own Treasury bonds so that they can pump up the price of money. That's really what this is all about. It's a very fun game that the Fed likes to play. They're very secretive about stuff. Okay, so let's get over to the chart and see what's been going on here. I'm going to clear out everything I've got. But I want to know, this is the long-term time frame. This is the monthly time frame we're looking at here. So we're looking at everything back to the year 2000. So I'm going to be looking at long-term trend right now. And really, I just want to know what's overall going on here. Here's our trend that we've been on for the last 10 years. That broke in March. Okay, so this is the beginning of the COVID madness right up here. Okay, that's when, let's just say demand fell heavily in the United States because we shut it down. Okay, and the market's been falling since then because we've been printing trillions of dollars to support a shutdown economy. We've been very aggressive with stimulus here. So our more recent trend has been pretty obviously down. We broke our uptrend, but this is what we're looking at more recently. And we've been on that line there for well, or close to it, on this downstroke since March of last year. And we're basically at the 1-year low right now. So the Fed is coming out right now, not so much the Fed, Janet Yellen, the government is coming out and saying that interest rate hikes might be good for the U.S. economy. The Fed, on the other hand, not the government, is saying that it won't be that great. I think that we come to a slightly lower range, and I think for a lot of reasons that you guys just saw me draw this box here, I'll give you guys a little bit more reason why I did that. But here's our fib range on our monthly time frame. And just to look at this here, what I'm anticipating on this ABCD pattern, I'll just draw this, okay? Here's our A up top, here's our B, here's our C, and I think we come down here. But I think the reason why Yellen is coming out and saying things like this is not because they're actually going to raise rates. I think she just wants to scare people into thinking that they're going to raise rates, because at the end of the day, that kind of achieves the same thing. They don't want the stock market to get pumped up too much, because it will crash if they raise interest rates in a year and a half, and they don't prepare people for that, because it will just go on a run. People will be completely risk on, and the market will hit highs like we've never seen. If they scare people, they can taper off some investors, they can slow this fall, and they don't really have to do anything. The biggest tool that the Fed has, and the government in general, is psychology. They want you to believe certain things at certain times, and I think that this is one of those, so that they can avoid this breakout toward the south and hit these lower levels. Or, if nothing else, just slow it down from happening so that the eventual low on this market doesn't end up being somewhere down here. Okay, so they don't really want to affect price a ton if they don't have to. They want to keep it from moving as much as possible. There's going to be some big opportunities that a lot of people are going to get faked out on. And I'm going to show you how in our Friday session. If you are not already a client of ours, go ahead and send us an email to brokers@123trade.com if you want to know how to get free access to my trading sessions on Fridays. Other than that, we also have tools bonuses. Smart Trader, we have up to $22,000 in bonuses that you can get from us at no cost. So that being said, you'd be crazy not to join, I think crazy. If you haven't already, go ahead and you like the video, give us a thumbs up. Like the video. Subscribe if you want more information like this on a regular basis. We're going to be putting it out all the time. Then click the bell so you can get notifications when these come out. Our website's going to have all these videos as well on 123trade.com. Otherwise, thank you for joining me in this talk about inflation and interest rates. You guys have a great rest of your day. Enjoy your week.